Welcome to the Dip Dive. Today, we're tearing into the Q3 2025 13F filing from Seth Klarman's Baupost group. And, when Klarman makes a move, it's worth paying very close attention.
It absolutely is. He's always focused first and foremost on minimizing risk, so his actions tell you a lot. And this quarter shows some really decisive action.
I saw the portfolio value ticked up a bit to, around $4.76 billion?
Yeah, $4.76 billion.
Right.
But what's more important really is how concentrated that capital is. That hasn't changed.
Exactly. The top 5 holdings still make up almost 47% of the entire portfolio. So these aren't just minor tweaks. We're looking at his highest conviction bets.
And we've got two huge narratives to unpack from this filing. The first is just fascinating. A rare strategic split between Seth Klarman and Warren Buffett on a huge tech stock.
Oh, we're definitely getting into that.
And the second is a perfect picture of Klarman's barbell strategy. Balancing these safe, quality businesses with much more complex, event-driven workouts.
Okay, but before we jump in, we have to address the data. There were some conflicting reports out there, but the official Q3 filing confirms it. Klarman made some aggressive trims to long-term winners.
That's the key. Specifically Alphabet and Wesco.
Right. And then he redeployed that cash into brand new high-conviction ideas. We're talking massive adds to companies like QSR and Elevance Health.
It's a textbook example of capital efficiency. Take your winnings off the table and put them to work where you see a bigger margin of safety.
And as we dig into all of this, just a quick reminder for everyone listening, all our analysis is based on publicly available sources. It's for educational purposes only, and it's definitely not investment advice. Please do your own due diligence.
And, speaking of diligence and watching the market, if you're trying to get a feel for the overall market temperature, whether things are getting frothy, we really encourage you to check out our iOS app, Buffett Indicator.
It's a great tool. You can just search for Buffett Indicator on the Apple App Store. It gives you a real-time pulse on the market.
It does. It's a great way to get some context for these kinds of moves.
Okay, let's do it. Let's get right into the headliner move of the quarter, the great divergence over Google.
This is just a masterclass in seeing how two brilliant minds can look at the same asset and come to completely opposite conclusions in the exact same quarter.
So lay it out for us. Klarman's Baupost trimmed its Alphabet position, that's GOOG, by almost 30%.
29.46% to be exact. A major trim.
And at the same time, Berkshire Hathaway is initiating a brand new position for billions.
A massive one, a $4.3 billion new position. It's an incredible divergence.
So, why? Why does one of the world's greatest value investors sell right when the most famous value investor of all time finally decides to buy in?
It all boils down to their primary focus. Klarman is a margin of safety purist, but he comes at it from a risk-first perspective. He's not Buffett. He's not a buy and hold forever guy.
He's an investor in price.
He's an investor in price and quantified risk. And you have to remember, his entry point on Google was phenomenal.
Right. He got in during the Q1 2020 crash.
At the bottom. He rode that all the way to a reported 192% gain by this quarter. So with the stock trading up near 255, his price-based margin of safety, it just shrank.
Okay, that makes sense. But there's another layer here, right? The lawsuit.
Exactly. The unquantifiable risk. For an investor like Klarman who hates binary outcomes, the U.S. Justice Department's antitrust lawsuit seeking a breakup of the company, that's a flashing red light.
So he's not saying Google is a bad company now.
Not at all. He's saying that potential 192% return is no longer worth the risk of a forced breakup. It's time to take the money and run. He's realizing the profit.
Which makes perfect sense for his strategy. So then what did Buffett and Berkshire see? This must have been them finally correcting what Munger called a sin of omission.
That's it, exactly.
Yeah.
Munger famously said failing to buy Google years ago was a huge mistake. So for Berkshire, they're not worried about the short-term antitrust noise. They're buying the durable moat.
The brand, the network effects.
All of it. And they're looking at the $90+ billion in CapEx guidance for AI infrastructure and seeing AI as a moat extender, not a disruptor.
And even with the price run-up, the valuation was still pretty reasonable compared to its peers.
It was. GOG was trading at a PE of around 27x. Amazon was up around 34x. Microsoft at 37x. Morningstar had just raised their fair value estimate to $340.
So, to synthesize, Klarman sold because the risk was too high for the price, but Buffett bought because the quality was so high, it justified that price.
It's a masterclass. A perfect example of two different but equally valid value investing philosophies.
Okay, that covers the big sell. So now let's talk about where he put that money. This is where we see that barbell strategy you mentioned in action.
Yes, the two biggest ads this quarter are just perfect examples of this split. On one side, you get this super high-quality, safe business, and on the other, a really complex, deep value workout.
Let's start with the quality side. Elevance Health, ticker ANTM. This was a huge ad, up over 114%, making it his third largest holding.
It's a massive vote of confidence.
So what's the moat here? What makes this a Buffett-style company?
It's all about scale and regulatory hurdles. Elevance serves over 117 million people. That scale gives them immense negotiating power with hospitals. Plus, they've vertically integrated through their Carelon Services platform.
Which includes their own PBM, their pharmacy benefit manager.
Right, which just makes their moat wider and deeper. It's a fortress.
But for Klarman, even a fortress has to be on sale. The valuation must have been the trigger.
Precisely. This is the classic, wonderful company at a cigar-butt price. It was trading at a normalized PE of just 10.6.
Wow, okay.
I mean, its 5-year average is almost 18. Morningstar was calling it one of the most undervalued stocks out there. There's a price-to-fair value of 0.69. It's a castle priced like a shack.
Okay, that's the high-quality, safe end of the barbell. Now for the other side, the classic Klarman workout bet. Restaurant Brands International, or QSR.
The parent of Burger King, Tim Hortons, and Popeyes.
And he was even more aggressive here. A 104% ad, making it his new #1 position. And this company looks nothing like Elevance Health.
It's the polar opposite of a fortress balance sheet. QSR is a 3G capital company, famous for using extreme financial leverage. This isn't a quality play, it's a complex turnaround bet.
And that leverage it's a huge red flag. Net debt to EBITDA is over 6 times. Debt to equity is over 237%. I mean, for most value investors, that's an immediate disqualifier.
It absolutely is, unless you believe management could pull off a high-risk, high-reward turnaround. Klarman is betting on the execution of their new 5-year growth plan to get to 40,000 restaurants.
So the margin of safety isn't in the balance sheet. Where is it?
The margin of safety is in the market's discount. The stock is cheap because of the leverage and the execution risk. Klarman is basically underwriting the very risk that the rest of the market is running away from.
That's a fascinating way to look at it. And this rotation isn't just about 2 stocks. The whole filing seems to show a major thematic shift.
It does. If you zoom out, you see Klarman is systematically trimming those old event-driven winners and plowing the cash into the U.S. industrial and infrastructure complex.
Let's talk about the trims. He cut Wesco by almost 32% and Willis Towers Watson by over 17%. These were big holdings for him.
Huge. And in both cases, the special situation had played out. For Wesco, it was the successful and very complex merger with Annixter. For Willis Towers Watson, it was the turnaround after the Aon merger collapsed.
The stocks re-rated, the thesis was complete, and he moves on.
He moves on. The margin of safety closed.
Yeah.
He even trimmed CRH, the building materials giant, for the exact same reason. The valuation just got too close to fair value.
So he's clearing the deck of these old stories and buying into a new basket of infrastructure bets. What's in that basket?
The theme is crystal clear. It's a multi-billion-dollar bet on U.S. reindustrialization. The biggest new buy is Union Pacific, UMP. It's immediately a 7.4% position.
A classic railroad duopoly, irreplaceable asset.
A classic wide moat business. But again, Klarman layers on complexity. He's not just buying the railroad. He's buying the potential for a complex future merger with Norfolk Southern.
He's also adding new positions in companies like Genuine Parts Co. and Americold Realty Trust.
Yeah, GPC is a distribution moat, and Coal D is a pure asset-based bet on cold storage warehouses. He's reinforcing the physical asset theme everywhere.
And adding to existing industrials like Eagle Materials and Ferguson.
Exactly. EXP and Avcur, the shift is unmistakable. Out of post-merger financial plays and into the real physical economy, manufacturing, infrastructure, electrification.
So wrapping this all together, what does this quarter really tell us about Klarman's discipline? It feels like a lesson in ruthless objectivity.
It is. At the end of the day, Klarman invests in price and risk, not quality for its own sake. He has the discipline to sell a wonderful company like Google when the price is right.
And at the same time, he's totally comfortable piling into companies with huge red flags like the leverage at QSR or the operational chaos at Fidelity National, FIS.
FIS is a perfect example. He held it steady. They're going through this incredibly complex, painful process of unwinding their $43 billion WorldPay acquisition. The market hates that uncertainty.
So it's cheap.
It's trading at a huge discount because of that chaos.
And that, I think, brings us to the most provocative thought from this whole filing. For Klarman, things like complexity, high leverage, or internal chaos, they aren't disqualifiers.
No, absolutely not. In many cases, they're prerequisites. That chaos is what creates the enormous margin of safety that a traditional quality investor, like a Buffett, might just pass on. He's hunting for the discount that the market's fear provides.
That is a powerful idea to end on. Do you hunt for quality, or do you hunt for the discount that complexity creates? A fantastic breakdown. Thanks for walking us through this.
My pleasure. It's always insightful to see conviction like this in action.
And for our listeners, as a final action step, remember, you can track that overall market temperature for yourself with the Buffett Indicator iOS app. Just search for it in the Apple App Store.
And for more advanced content and deeper analysis like this, welcome to join our Deep Value Club membership.
Don't forget to subscribe to us on Apple and Spotify podcasts at Deep Value Investing. We'll catch you on the next deep dive.